The global gold mining industry faces an unprecedented structural challenge that could fundamentally reshape precious metals markets within the next decade. After centuries of extracting the most accessible, highest-grade deposits, major mining operations are confronting a stark reality. Ore quality has declined precipitously, while extraction costs have soared exponentially. This phenomenon represents more than cyclical market pressures. It signals a permanent shift in the economics of gold production that will define the industry for generations ahead. Industry data reveals a sobering trend across major gold-producing regions, spanning 5 key geographical areas worldwide. Average ore grades at established mines have fallen by approximately 50% over the past 2 decades, with some flagship operations experiencing even steeper declines that threaten their long-term commercial viability and operational sustainability. South Africa's Witwatersrand Basin, once the world's gold capital producing over 40% of global output, now yields ore grades averaging 3 to 5 grams per ton, compared to 15-20 grams per ton during peak decades of the 1970s and 1980s. This deterioration extends beyond isolated cases to encompass virtually every major mining jurisdiction globally. Major mining conglomerates report similar patterns across their diversified global portfolios, creating systematic downward pressure on industry profitability and return on invested capital. Barrick Gold, the world's second-largest producer by market capitalization, has seen average ore grades across its global operations decline from 4.2 grams per ton in 2005 to 2.8 grams per ton by 2024. Newmont Corporation faces comparable operational challenges, with declining grades forcing the company to process substantially more rock material to maintain production targets, often doubling or tripling waste rock ratios and increasing environmental impact. The physics of this decline are mathematically predictable through established geological models. As high-grade, near-surface deposits become exhausted, miners must dig deeper and process lower-quality ore according to geological principles. This progression follows Hubbert's peak theory. Resource extraction follows a bell curve, with the easiest and richest deposits exploited first, leaving increasingly marginal resources for future extraction. The theory, originally applied to petroleum, proves equally applicable to hard rock mining. Australian operations exemplify this trend, with the Kalgoorlie Super Pit experiencing grade declines from 2.8 grams per ton in the 1990s to 1.4 grams per ton currently. Similar patterns emerge in Canada's Timmins district, Nevada's Carlin Trend, and Ghana's Ashanti region. The convergence of these trends across diverse geological settings suggests fundamental resource constraints rather than temporary issues. The economic implications cascade through every aspect of mining operations, creating compounding pressures that threaten industry margins. Processing lower-grade ore requires proportionally more energy, water, chemicals, and labor per ounce of gold recovered, fundamentally altering the cost structure of the industry. Energy costs alone can represent 20 to 30% of total mining expenses, and these costs multiply exponentially when processing volumes increase while output remains constant or declines. Advanced extraction technologies, while improving recovery rates marginally, demand significant capital investments that extend payback periods. Heap leaching, carbon and pulp processing, pressure oxidation, and biooxidation can extend mine life, but at substantially higher operating costs. The payback periods for these investments have lengthened from 3 to 5 years to 8 to 12 years as ore grades continue declining, creating a challenging capital allocation environment for mining companies facing shareholder pressure for returns. Labor costs compound the operational pressure beyond simple wage inflation. Deeper mines require more specialized workers, enhanced safety protocols, sophisticated ventilation systems, and advanced equipment operated by highly trained personnel. Underground operations in South Africa and Australia report labor costs per ounce that have doubled over the past decade, even accounting for productivity improvements through automation, digitalization, and artificial intelligence applications. Transportation and infrastructure costs amplify these challenges in unexpected ways. Lower-grade ores often necessitate moving greater volumes of material over longer distances, straining existing infrastructure and requiring additional capital expenditure on roads, railways, processing facilities, and waste storage areas. The environmental footprint of mining operations expands proportionally, creating additional regulatory compliance costs and community relations challenges. Water management becomes increasingly complex as mines deepen and processing volumes increase. Many operations now require sophisticated water treatment facilities, recycling systems, and environmental monitoring that can add 10-15% to operating costs. In water-scarce regions like Nevada and Western Australia, these challenges intensify as companies compete with agricultural and municipal users for limited water resources. The mining industry's response to declining grades follows predictable economic patterns rooted in operational necessity rather than strategic choice. Companies initially attempt to maintain production through operational efficiency improvements and technological upgrades, squeezing additional productivity from existing assets. When these measures prove insufficient to offset grade decline, they pursue three primary strategies: mine expansion, merger and acquisition activity, and exploration investment, each presenting distinct risk-return profiles. Mine expansion typically involves accessing deeper ore bodies or extending operations into previously uneconomical areas using advanced mining techniques. However, these expansions require substantial capital commitments with increasingly uncertain returns due to geological complexity, regulatory hurdles, and technical challenges. Environmental permitting has become more complex and time-consuming, often requiring 5 to 7 years for major expansions, adding significant regulatory risk to already challenging projects. Consolidation activity has intensified as companies seek economies of scale and portfolio optimization to spread fixed costs across broader production bases. Larger operators can invest in advanced technologies that smaller companies cannot afford, including autonomous mining equipment, real-time ore grade monitoring, and sophisticated metallurgical processing. This trend toward consolidation may accelerate as marginal producers face insurmountable cost pressures and declining access to capital markets. Exploration spending has paradoxically declined, even as the need for new discoveries has intensified, creating a concerning supply gap. Major gold discoveries have become increasingly rare, with the last significant finds occurring in remote locations requiring substantial infrastructure development and multi-billion-dollar investments. The lead time from discovery to production now averages 15-20 years, creating a dangerous gap between current depletion rates and potential future supply additions. These supply-side pressures create a structural floor beneath gold prices that differs markedly from historical patterns dominated by monetary policy and geopolitical factors. Traditional gold price models focused primarily on real interest rates, inflation expectations, currency movements, and safe haven demand during crisis periods. The emerging supply constraint adds a new variable to the equation: the marginal cost of production, which continues rising independently of macroeconomic conditions. Industry analysis suggests that all-in sustaining costs for new gold production have risen to $500 per ounce for many operations, compared to the $1,000 per ounce a decade ago. This cost inflation occurs independent of monetary factors, creating a price floor that may persist regardless of central bank policies, interest rate cycles, or macroeconomic conditions. The phenomenon resembles oil market dynamics, where declining conventional reserves force extraction from increasingly expensive sources. The price discovery mechanism may shift geographically as traditional Western mining centers face production challenges. Emerging market producers with relatively untapped reserves could gain disproportionate pricing influence, potentially reducing the correlation between gold prices and Western financial market sentiment, while increasing sensitivity to emerging market political and economic developments. This transition could fundamentally alter how investors approach gold as a portfolio diversification tool. Seasonal patterns and cyclical demand variations may become less relevant as supply constraints tighten. The traditional Q4 demand surge from jewelry fabrication and investment demand could create more pronounced price spikes if supply cannot respond flexibly. Physical premiums over paper prices may become more persistent and substantial if supply shortages create bottlenecks in delivery chains. The resource depletion crisis poses profound strategic challenges for central banks, institutional investors, and the broader financial system that extend beyond traditional precious metals considerations. Central banks holding significant gold reserves may need to reassess their acquisition strategies as price volatility increases and supply becomes less predictable, potentially affecting international monetary system stability. For institutional investors, the traditional relationship between gold and real interest rates may weaken substantially as supply constraints become more binding than monetary conditions. Physical gold markets could increasingly decouple from paper gold instruments if supply shortages create persistent premiums for immediate delivery, challenging the fungibility assumption underlying many investment strategies. Mining companies face increasingly difficult strategic choices that will determine industry structure for decades: continue operating marginal mines at current prices, accepting lower returns, invest heavily in exploration and new technology despite uncertain payoffs, or gradually exit the industry through divestment and closure. These decisions will collectively determine whether the gold market experiences a gradual supply reduction over 10-15 years or more abrupt contraction that could trigger severe price dislocations. Jewelry manufacturers and industrial users may need to develop substitution strategies or accept higher input costs that could fundamentally alter their business models. The electronics industry, which consumes approximately 8 to 10% of annual gold production, may accelerate research into alternative materials for critical applications where gold's unique properties are currently irreplaceable. The gold mining industry stands at an unprecedented inflection point where geological realities increasingly constrain production growth despite rising global demand, from emerging market central banks, technology applications, and investment diversification needs. The supply-demand imbalance represents a fundamental shift from historical market dynamics driven primarily by monetary and geopolitical factors toward resource scarcity economics. While technological innovations may partially offset declining ore grades through improved recovery rates and operational efficiency, the physics of mineral extraction suggests that dramatic cost increases are unavoidable, absent major new discoveries. Market participants should prepare for a new paradigm where supply-side constraints play a more prominent role in gold price formation, potentially leading to higher price volatility, structurally elevated price levels, and reduced correlation with traditional financial market drivers. The transition from abundant, high-grade resources to scarce, costly deposits marks not just a cyclical challenge, but a secular shift that could reshape precious metals markets for decades to come. This transformation may ultimately enhance gold's appeal as a store of value while fundamentally altering the industrial and investment landscape surrounding the world's oldest monetary metal.